we're going to dive into a significant event that shook the crypto world on October 10th, 2025. It was a day when Bitcoin and the entire crypto market saw over $19 billion in leveraged positions vanish in just a few hours. This wasn't just a typical market dip, was it, Rachel?
Not at all, Jake. While it started with a broader market risk-off move after a surprise tariff announcement from Trump on Chinese imports, which impacted global markets and spilled into crypto, the real story lies in the specific mechanics of large centralized exchanges like Binance, particularly their perpetual futures trading.
So it sounds like the initial spark was macroeconomic, but the crypto market's internal structure turned it into a wildfire. Can you explain how this perpetual futures trading with leverage works for listeners who might not be familiar?
Certainly. When you trade futures with leverage, let's say 100 times, you're essentially borrowing money from the exchange to place a much larger bet than your initial capital. You put up only a small margin. If the price then moves significantly against your position and that margin drops too low, the exchange automatically forces a liquidation. It sells your position to cover the loan.
That seems like a standard risk management procedure. What made October 10th different? Why did capital get wiped out so quickly, beyond just standard liquidations?
That's where the unique mechanisms come in. Normally, if a position can't be closed at a good price during a rapid drop, the exchange's insurance fund steps in to absorb some of those losses. However, on October 10th, the sell-off was so intense that Binance's insurance fund was drained extremely fast.
And what happens when the insurance fund is exhausted? Does the exchange just take the hit?
Not exactly. This is the crucial part that many traders overlook in the terms of service. Exchanges like Binance then trigger something called auto-deleveraging, or ADL. ADL doesn't just liquidate the losing positions. It forcibly closes the positions of profitable traders on the opposite side of the market. It's a mechanism to balance the books and protect the exchange from going into a negative equity position. The source material describes it as, quote, socializing the losses. Winners get deleveraged to pay for the losers who blew up, end quote.
Wait, so even if you were making money and predicting the market correctly, your profitable trade could still be forcibly closed to cover the losses of others? That seems like an incredibly harsh system, almost punishing success to offset failure.
It is, and it adds a layer of risk many traders aren't fully aware of. On top of this, during the chaos of October 10th, Binance experienced significant technical issues. There were API problems and server overloads, preventing traders and market makers from getting orders through, especially reduce-only orders designed to close or hedge positions. Market makers, seeing the instability, pulled their liquidity.
So not only were profitable traders being deleveraged, but those who wanted to manage their risk couldn't even execute their trades, and the market itself became less stable due to a lack of liquidity. This sounds like a perfect storm for a cascade of liquidations.
Precisely. Order books thinned out, prices flash crashed on Binance far lower than on other exchanges, which then triggered even more liquidations in a vicious cycle. The rules governing ADL, how liquidation prices are calculated, and the exchange's right to intervene in extreme events are all spelled out in Binance's futures terms of use and risk disclosures. Most people simply click agree without reading them, but those documents are what allowed this deleveraging of winning positions.
It's a stark reminder of the fine print in financial agreements, especially in such a volatile space. Despite this painful market event, does the long-term outlook for Bitcoin and the broader crypto market remain positive?
Yes, actually, the long-term outlook for Bitcoin still appears solid heading into 2026, according to this analysis. The October 10th event, while brutal, is viewed as a necessary, quote, deleveraging flush-out of excess leverage, end quote. It's like clearing out dead wood from the system. Post-crash, the market has been consolidating around the $90,000 to $95,000 mark for Bitcoin.
So this correction, as painful as it was, might ultimately lead to a healthier market environment.
That's the perspective. Institutional flows remain steady, Bitcoin ETFs are still accumulating, and there are positive macroeconomic tailwinds on the horizon, such as potential Fed easing. Over-leverage was punished, liquidity is improving as market makers rebuild, and Bitcoin's core fundamentals, its scarcity, increasing adoption, and network strength, remain unchanged. Events like this often serve as local bottoms, setting the stage for healthier rallies in the future. So the analysis concludes that the future's still bright.
It seems that while the experience was tough, it might have been a necessary reset for the market. If you found this discussion insightful, share it with someone interested in understanding the hidden mechanics of crypto markets.